Hello, my name is Kevin McCormick, and I am with a group in the Green Party called greensformonetaryreform.org. Well, that's our website, greensformonetaryreform.org. And I have a little presentation that I'm going to show here on this video about the Federal Reserve and compound interest. This is just some observations that I've made. It's I think it's interesting, but it's not any kind of like deep economics or anything. But maybe it is. The slide presentation is my effort to demonstrate the basic nature of the Federal Reserve monetary system. The Federal Reserve was created in 1913. Since that time, it has steadily grown in influence and power to the point where it seems that federal government policy is about little else than serving the demands of the banking cartel and the corporations it finances. This 2009 quote from Senator Dick Durbin of Illinois sums up the situation. And the banks. Hard to believe in a time when we're facing a banking crisis that many of the banks created are still the most powerful lobby on Capitol Hill, and they frankly own the place. And this was said on WJJG 15:30 a.m. Mornings with Ray Hanania, and I found that on the internet. There are many commentators who have described the undue influence of the banking cartel, and you are encouraged to investigate this subject further. I want to focus on one aspect of the money system, which is the need for what is called growth. This is fundamental to the Fed money system because it is based on debt. The Fed money system is based on debt. The commercial banks have the privilege to fund loans by creating new money. This new money is loaned to the borrower at interest, but there is no money created specifically for the interest. The interest must come from money created by subsequent loans and circulated in the economy. Thus, the money system must continuously expand in order for the existing debts and interest to be paid by subsequent debts. I would also add in there the way that the Federal Reserve System works. You know, when the banks create a loan, they credit the borrower's account. And then that account balance can be translated into currency or used for payments as if it was money. And they did not have the money in the first place, the bank, but the bank has the right or the privilege to create that money, and the Federal Reserve note does say legal tender for all debts, public and private, on your Federal Reserve notes if you take a look. So the money system has to expand in order for the interest to be there for paying the loans. But there's another thing too, is that when those loans are paid back, that money disappears from the economy. The balance on the bank asset account, which is where the loan is reduced, and the money it basically disappears. I mean, it's basically returned to the banking system, and it goes away. It's destroyed, as they say. So money's created by credit and is destroyed by paying the debts back. So this creates a tremendous incentive for new debt, not only to pay the interest on the existing debt and to be able to pay off the existing debt, but also to keep more money in circulation and keep the economy going and things like that. And the banks have basically made themselves indispensable in this process, but that is a matter of politics rather than a matter of, something that is the optimal situation. Okay, and the money inflation, the banks, they're constantly getting people to borrow money, and either there's an inducement or you're in a situation where you have no choice. So you'll see the inducements in real estate speculation and the situations where you have no choice are things like car loans, consumer debts, student loans. And you could argue about whether student loans are voluntary or not, and I suppose that's a mixed case. But I think there are a lot of people who feel they have no choice in that matter. So we have more and more debt, and of course, the way the system is structured, there will not be enough money ever in this system to pay all the debt. So that's the situation, and what it ends up with, I think, is that you have this exponential growth, and that's what we're going to get into now. I'll start this slide presentation, and let's see if we can share the screen here. And let me see here. This is the Zoom thing. So okay. All right. We'll start our slideshow. Compound interest and the Federal Reserve money system. Compound interest. Let's talk about that first so that we know what we're talking about. Compound interest is the addition of interest to the principal amount for the next interest period. So you collect interest, say it's an annual interest period, so you have 1 year, then you collect the interest, then you add that to the principal, and then for the next year, you're calculating interest on the original principal plus the first year interest. And then the second year is added, and so for the third year, it's the first and second year interest added, and so the amount that you're collecting interest on increases, it compounds. It's a form of exponential growth and can be thought of as constant percentage growth of a compounding amount. So if you hear a statement like the economy grew by 4% this quarter or this year, whatever, that is an interval of exponential growth. And people, creditors and investors, they like compound interest because there are incredibly high returns that can be obtained over a period of time with compound interest. But in order to have the money to make those payments, you have to inflate the money system so you have monetary inflation. You can find a good explanation of the math for compound interest at www.mathisfun.com/money/compound-interest.html. And the calculations in the slides I'm going to show here are done by annual compounding. The data that I'm using is annual data. And and I just begin with the starting amount of whatever data series I'm working on. And the data series that I use are taken from the Federal Reserve of St. Louis. Their website is called FRED, F-R-E-D, .stlouisfed.org, O-R-G. Okay, next slide. So this is the compound interest pattern. And what this tells us is that the compound interest calculation and the result starts out very moderately in the beginning, but it has a doubling period. It has a doubling time. And you can calculate this by dividing 72 by the percentage. And in this case, I'm using 6.6%. And if you divide 72 by 6.6, you get 10.9. So that's about 11 years. And what I want to point out on the graph here, you can't see it, but we start with $1. And in period 11, it has increased to $2.02. In period 22, it's $4.08, and in period 33, it's $8.24, and so on. So every 11 compounding periods, the amount is going to be doubled. And as an example of what happens as compound interest goes on, Here in period 72, the amount has risen to $99. And in period 83, 11 years or 11 periods later, it's 201, so it's doubled. And in period 94, the amount is 406, so it has doubled. And at 100 periods, the graph shows the $1 has risen to $596.65. And by period 111, it would be around $1,200. So that's the story of compound interest. It seems pretty innocuous in the beginning, and then it gets to be enormous amounts. So the point I want to make here is the math of compound interest drives the Federal Reserve monetary system. Okay, the banking cartel has one primary source of power and influence, and that is the money creation that we described earlier. So the commercial banks create money when they fund loans. And I talked about how they don't create the money for the interest. So even if everything would zero out, and somehow or another the money that you borrowed, you could get all that money back to pay the loan back, you would not have enough because you need more for the interest, and there is no money created for that. So therefore, that would be impossible. But think about this privilege of money creation. If you had a magic checkbook, for example, and you could write as many checks as you wanted for any amount that you wanted, and they would never bounce, you would become very influential, much as the banking cartel has become in the United States. And another thing that would happen over time, you would learn to give the checks that you wrote to people who would help you out and who would help preserve your privilege. And that's what happens. So for the most part, you'll see banks are willing to loan into activities that tend to create a greater demand for credit. So, and they also definitely support things that lead to a need for money. So, that's their power, money creation. If everybody needs their money, if everybody's always borrowing and needing more money, then that is the situation that's favorable to the banking cartel. Well, what happens, this works itself out as to follow a pattern of compound interest. And because the existing debt is always compounded, and in order to make everything work. So it's described as growth in in the news, economic reports. You'll hear about the possibility of economic growth, but it's not really economic growth. It is monetary inflation, and but we just don't want to describe it that way because propaganda. They don't want you to know what's really going on. Okay. Let's look at the money supply, and now I'm going to get into some slides here with graphs. The first one is M1, which is cash in the money supply. It's things that are readily there for spending: cash, currency, traveler's checks, demand deposits, and checkable deposits. So it's your checking accounts, whatever traveler's checks are out there. That's probably a very minor part of it. And then, the currency, the dollars in your wallet. Okay, the compounding rate that it's followed since 1960 has been around 5.75%. And you see the orange curve, which is the compound interest curve, and then the dark blue line is the amount of the M1 money supply. Now, since 2008, it has risen at about what looks like 9.6%, rough estimate, but it is much steeper increase than it was from 1993 or so up to 2008. That was pretty flat. and then it really picked up quite a bit since 2008. And the economy seems to be doing better, and I'm pretty sure there's a connection there. Okay, the M2 money supply. This is a larger aggregate, and this includes savings deposits and time deposits, CDs, money market funds. So M2 is much larger than M1, but it includes M1. Now, its rate of increase has been around 6.6% per year. And you can see the red curve is the compound interest curve, and the blue curve is the M2 money supply. In 1960, it was 301 billion, and in 2017, it has increased to 13,274 billion, or 13.3 trillion. So that's the compound interest magic over a long period of time. Okay, matching loans to money supply. Now, in this graph, I have the green line is the debt, securities, and loans, the asset level. See, debt, securities, and loans are considered to be assets for banks because they're collecting interest on them. They're like investments. And but what happens when they make these loans, of course, the money that is borrowed is then becomes the M2 money supply. That becomes the money in the economy. So we can see that the asset level for the banks very closely tracks the M2 money supply. And it does seem to be where the M2 money supply is a little higher after 2000, and it looks like about 2012, and I'm not sure why that is. I would expect the loans to be just a little bit higher than the money supply, which they were all the way up until 2012. And anyway, I don't know why that is. Okay, the national income, this is just part of the gross domestic product calculations by the Bureau of Economic Analysis. And it's followed a 6.6% curve, although it was higher, and then it dipped in 2008, and it has not been increasing as rapidly as it was before. But, it might be. Anyway, it seems like it's closer to 4% since 2008. Okay, and now the U.S. gross domestic product, which is, again, very similar to the national income. It's pretty much a lot of the same data. And you can see the curve is very similar. And again, you could model it with a 6.6% compound interest curve up until 2008, when it kind of changed its pattern. Seems to be 4% around now. Okay, now I want, in this slide, we compare M2 to GDP. Both of them have a 6.6% curve. That's the red and orange lines there. But the GDP number begins at a higher number. So it's increasing. Since it started at a higher number, it's increasing a little bit more as it goes on. GDP should be higher than M2 because you have more than one transaction per dollar in M2. Okay. Now, private credit, total private credit. Now here, this is credit extended to non-financial corporations, public and private households, and non-profit institutions serving households. And now, not all lenders have the privilege of creating money, and I think that's an important point. It's the commercial banks, the banking cartel, that has the privilege of creating money. Other lenders like finance companies or maybe people on Wall Street who buy municipal bonds or things like that, They did not create the money that they lend out, but so that's in addition to whatever the banks are doing. So the pattern for private credit has been 8.6% compounded, as you can see, up until 2008 again. And now its growth seems to be, around the 4%. But again, in the modeling on a short series from, say, 2010 to 2017, you just don't have enough data to make a judgment of what the long-term growth rate is. But anyway, it grew from almost 400 billion in 1960 to now it's 28,435 billion in 2018. So this is again, some inflation in there somewhere. Okay, compare M2 GDP and credit. So this puts the these three monetary aggregates that we've looked at side by side so we can see how they relate. And in 1985, private credit exceeded GDP. And this was at the level of 190% of M2, so almost twice as much as M2. But, oh yeah, this was after Ronald Reagan, and the Reagan policies were very favorable to finance. So private credit really started growing at that time. And now in 2008, it had reached 328% of M2, and GDP was 196% of M2. So the private credit has increased a lot, whereas GDP has basically stayed with that 2-to-1 relation to M2. But in 2017, there's a little bit of a change because credit is 214% of M2 and GDP is only 147%. So instead of being 2 times M2, it's 1.5 times. So I think that probably means something, but again, I'm not trying to get into a lot of economic analysis. I just want to show how compound interest is the pattern here. The federal debt. We all want to hear about that. Okay, so the matching that I did, the compound rate is around 7.6%, so that's higher than M2. And the doubling time is around 9 years. So interestingly, the federal debt will double in roughly 2 presidential terms, which we have seen that. It doubled under Bush, then it doubled under Obama, and I am quite certain it will double under Trump. So now to compare M2 and the federal debt, my cat wants to get up here. I'll keep her back. Okay, so the federal debt is greater than M2 in 1990. So up until 1990, the federal debt was less than the money supply. Now it's 152% of M2. So, and I wanted to note that I've heard economists say that the federal debt is the source of money in the economy, but I'm not clear on how that matches with the federal debt being 152% of the M2 money supply. If the federal debt was the money supply, there seems to be some of it missing. Okay, and now to give us some context, I want to relate this to population. So this graph shows that our population in the United States has increased by about 1.1% compounded. And now, and this graph goes back to 1929. Now we have about 326 million people. And so anyway, that's just to get the idea that the population growth has been at 1.1%. Okay, now let's do per capita money and debt. So this is how much money, how much debt there is per person. So you can see that it's gone up. The amounts back in 1960 were pretty low, well under 5,000. And now in 2017, private credit is $87,000 per person. Federal debt is $52,000 per person. The M2 money supply is $41,000 per person. And the M1, which is included again in M2, but M1 just taken separately is about $10,000 per person. So there you have a huge increase in money. That would be inflation, I think. Okay, comparing M2, M1, and the Consumer Price Index, the CPI. So just doing a percent change, the money supply has increased by 4,000% from 1960 to 2017, I think is where this series ended. M1 has increased by 2,000%, whereas the CPI, the Consumer Price Index, has increased by only 700%. So that's very interesting because, you know, I did not really get into economic statistics relating this to wage growth or labor's share of income or things like that. I don't think that people feel that they have become 6 times richer, which the M2 would apply. I mean, you know, so it's interesting because this does tell us that the money is going somewhere else besides to the people. Okay. Now, to talk about the Federal Reserve money system, and one of the points I want to make is that the debt is forced onto the public, and there are 2 basic ways, carrots and sticks. So you have the inducement or the carrot, and then the stick is necessity and lack of choice. So what drives this is that banks have to maintain a high level of performing loans. Payments are being made. And one of the things that banks love to do is mortgage and real estate loans. And where you see real estate inflating and going up in price, one of the main reasons for that is that this is one way the banks know that their loans are performing, because if the property that they have a mortgage on has gone up in price, it can be sold for more than the loan, and that way they can get paid back. It also is an inducement for people to buy real estate so they can speculate on price appreciation or price inflation, actually. Then consumer necessities, and in particular automobiles, are depreciating items, but they have to be replaced, and you have to get a new loan when they're replaced. So one of the things about cars is they depreciate a lot. And, you know, a lot of people have wondered, why do used cars go down so much, and why are used car prices taken down as much as they are? And one of the reasons is that when you buy a new car, you basically have to start over. So you have to borrow the money again. If your car held its value, the amount of credit associated with automobiles would be a lot less. And then you have, you know, anything you buy from a store with a credit card or an appliance on a payment plan or something like that. They lose most of their value pretty much right away, and you know, you'll have to finance it again when it's time to replace them. Okay. This is a slide I threw in here just to show the investor class, people who own a lot of stock. Since 2008, the S&P 100 stock market index has gone up by 17% compounded since since 2008. And I have a little inset here with the Dow Jones Industrial Average back in the 1920s, which showed that the Dow Jones went up by actually higher than 25% compounded rate up until the crash in 1929, when it then went all the way back down. Okay. So here I want to show real estate inflation. The green line is real estate market value, and the blue line is aggregate of mortgage debt. So this blue line, it says households and nonprofit organizations, home mortgages, liability. That's this data series. And what you can see is that the asset value, the market value, tends to rise a little bit faster than the amount of the debt, unless there's an upset in the market, which happened in 2008, and then the asset value, the market value, dropped quite a bit, and a lot of people got caught in that, where their mortgage was actually higher than the house. And this was, of course, a big crisis for the banks. So that's one of the main reasons that you have real estate inflation so much promoted in our economy. Okay. The banking cartel stick. Again, this is a situation where you have to borrow, and what I'm looking at here is motor vehicles and parts. This is personal consumption expenditure. And on the right, the graph shows an increase that basically goes along with the idea of 6.6% compounded up until, again, about 2008, when it dropped down, and now it looks like it's at a lower rate. And on the left side, I have a depreciation, where the asset is declining in value by 20% each year, which is about what happens to cars. So the average car, which I looked up on the internet, was around $30,000 this year currently. But in 10 years, it's worth less than $5,000. So when you have to replace the car, you basically have to start over with a new loan. And a lot of people actually never get out of making car payments. They do it all their lives, because the car that they need to turn in is worth less than the amount on their loan. And so, you know, it's one of those things. How do they handle that? And then revolving credit. My cat wants to get up here, and I just am trying to. That's the problem with cats and computers. So the revolving credit, but this one, revolving credit, has followed the 11% compound rate, which is you know, much higher than the money supply, and this went on up until 2008, and then it went down quite a bit, and it seems to be around 4% now, but that's just a guess. I mean, that curve is not smooth enough to make any kind of prediction with. Anyway, it has grown up to be quite a bit. It's $1 trillion. Now, one thing I did not, and I could not find the data for, is municipal bonds and local government debt, because that's one of the things they do. The government borrows money, and you're going to have to pay for it with your taxes. And I read that that's over $3.5 trillion now, so that has grown quite a bit. Okay. So some implications of all this. Monetary inflation has continued through numerous doubling periods. Remember, the Federal Reserve was created in 1913, and then it was in the 1930s that we recovered from the stock market crash and the Great Depression. And so We've had, we're getting on to getting 100 periods of continuous compounding, 100 years of compounding monetary inflation. So the amounts that we're talking about now are becoming much greater in absolute value, less manageable, even though the percentage, it's only a 6% increase or only an 8% increase. So we're in a situation where credit and debt must be inflated by any means available. So the inducements and the ensnarements, the bait of, all right, Kat, all right. We talked about the inducement of getting into real estate and the ensnarements of, the debt trap of your car and credit cards and things. Okay. So the Federal Reserve money system has been compared to a Ponzi scheme because of the constant need for new debt. I think that there's an implication that a society under this type of money system must be imperialist, expansionary, and exploitative because it's constantly driven by the need of debt inflation. Okay, conclusion, compound interest rules. Exponential growth modeled by compound interest is the defining pattern of the Federal Reserve monetary system. The money supply is a reflection of credit issued by the banking cartel using their privilege of creating money. Economic growth is a term to describe monetary inflation in a favorable light, but in fact this growth is simply the constant effort to create financial bubbles and justify new loans. We experience this through exponential monetary inflation. There will never be enough money to pay the debt at any given time, so the system must maintain this exponential growth in order to function. So that is the end of the slide presentation, and thank you for watching that. Okay, now we're back to just me talking. I'm sure you've seen that the idea that infinite growth is not possible on a finite planet. And I wanted to point this out in this compound interest presentation that the Federal Reserve System is really dependent on the concept of infinite growth and continuing compounding the amounts of debt in the system. And the numbers today are really large. And we're running into some limits here. The federal debt, well, it's obvious when you have the private credit being 3 times the money supply and the federal debt being greater than the money supply. How is it even possible to think that this debt could ever be paid? And really, it's about keeping the system going, but it just becomes more and more problematic because it's out of control, basically. Okay, well, thank you for watching, and check out the website greensformonetaryreform.org. We do on that website propose a different monetary system in the NEED Act, N-E-E-D, the NEED Act, and this is a monetary system that follows the Constitution and is based on a very detailed historical study of successful monetary systems in societies in the past. Again, this is Kevin McCormick, and thank you for watching, and good luck to you.